The first one will be Bank of China, which you may be familiar with. Bank of China is the first large commercial bank in China that has engaged in integrated operation with businesses covering investment banking, asset management, insurance, direct investment, leasing, consumer finance, technology finance, among others, which enable BOC to provide enterprise clients with comprehensive financial services. As at end of June 2023, it had a total of 532 overseas branches in 63 nations and regions, with the number of overseas branches proportion of overseas staff to total staff geographical coverage, ranking first in the banking industry in China. So compared to the other three state-owned banks, ICBC, CBC, and Agricultural Bank of China, Bank of China is more international, more exposed to other overseas branches. It has two listed companies in Hong Kong. BOC itself is listed as X share in Hong Kong, and its subsidiary BOC Hong Kong 2388, the ticker is 2388, is also listed in Hong Kong. Okay, but today we're talking about the parent company, BOC, Bank of China, 3988. Okay, this is the financial performance in the first quarter this year. Revenue decreased by 3.1%. Actually, other state-owned banks also saw declines in their revenue in the first quarter this year due to the economic slowdown in China. So average decline was around 4 to 5%. So BOC's revenue declined 3.1%, outperforming slightly its peers. Operating profit was down by close to 10%, and operating profit margin also down 6.8%. Net profit dropped less than the decline in revenues. Net profit only dropped by 2.9%, and net profit margin saw a slight increase. Earning per share dropped 5.26%. ROE and ROA are 2.12% and 0.17% respectively. Okay. This is last year, 2023 financial year. So last year you saw all of the indicators saw growth. For instance, operating income grew by 6.4% year on year. Net interest income grew by 1.58%. Net fee and commission income grew faster. This is also one distinct feature about BOC, is net fee and commission income grew much faster than its peers. Net fee and commission income grew by 5.3% last year. And PPOP grew 3.68%. Profit after tax grew 4%, and profit attributable to shareholders of the bank increased by 2.4% last year. So this is its financial results last year. Compared to the other 5 state-owned banks, namely ABC stands for Agricultural Bank of China, BCM is Bank of BOCOM, Bank of Communication, ICBC, Industrial Commercial Bank of China, PSBC is Postal Saving Bank of China, 邮储银行, CCB, Construction Bank of China, and Bank of China. You can see red line here, revenue growth, it outperformed in 2023, especially when the other 5 saw decline in revenue growth. Its revenue actually picked up, saw growth in its revenue and outperformed the other 5 competitors. Okay, it is quite diversified in terms of non-interest income. So its non-interest income ratio is less dependent on, compared to the other 5 state-owned banks. It's less dependent on interest income. You can see non-interest income accounted for 38% of its revenue, while the average for the other 5 state-owned banks is around 20%, much less than that of Bank of China. And the fee income breakdown here in the first half of 2023 is also quite diversified. You can see 25.4% comes from agency business, 17.1% comes from settlement and clearing, 13.4% comes from card businesses, and 12% from credit commitment, 11.6% from consultancy, 8.2% from custody and other entrusted business. Also, income from foreign exchange, buying, selling price difference, 5.6%. So one distinctive feature about Bank of China is non-interest income accounts for nearly 40% of its revenue, and non-interest income itself is very diversified. Okay, in terms of deposits, Bank of China's share of demand deposits in its total deposits was 42.5%, which is the middle level in the industry, with the personal corporate demand deposit ratios at personal demand deposit is 37.4%, corporate demand deposits is 52.4%. So demand deposits are also similar to fixed deposit. If the ratio is too high, the profit margin will be lower for the bank, because banks pay higher interest rate to fixed deposits or demand deposits instead of current savings. Okay. Manageable asset quality risk, NPL ratio is better than the average and also declining over time. On the left-hand side, you can see the balance of non-performing loans. Although balance of non-performing loans is growing because the loan portfolio is also growing, the NPL ratio actually is on a downtrend. You can see from 1.4% now dropped to 1.2%. And the right-hand side, it's a comparison of the NPL ratio among the 6 state-owned banks. It ranked the 5th, only slightly higher than PSBC. PSBC has the lowest NPL ratio among the six state-owned banks. The other 4 state-owned banks, their NPL ratio is exceeds 1.3%, while Bank of China is below 1.3%. Okay. But lower provision coverage ratio than peers. Its coverage ratio is likely less than 200%, while PSBC has the highest provision coverage ratio, more than above 350%. The rest ranges between 200 and 250%, but all of them are above the mandatory requirement coverage, provision coverage. Okay. Capital level, total capital ratio is 18.5%. So you can see in the last 2 years, its total capital ratio is on a rise, and Tier 1 capital ratio, represented by the blue line, also rose from 13.8% in the first quarter of 2023 to the first quarter this year to 14%. 14%. Okay. And CET1 capital ratio also improved from 11.63% to 12.02%. Okay. Interest margin. Interest margin, this is the growth rate. So you saw postal state saving bank saw the fastest growth in interest margin, but it's also coming down after the rapid growth. BOC, the interest margin actually remains quite stable compared to the other 5 state-owned banks. It does not it has not posted as rapid growth as PSBC, yet it remains stable over the last few years. The net interest margin, the NIM. Okay, but interest margin is expected to narrow because return on assets in mainland China is under pressure. As the market expects rate hikes to end, the company has been making active allocation adjustment on the asset side to help the property market. China has been lowering the mortgage rate cuts. Mortgage rates and LPR repricing. This has a negative impact on banks as a whole, because to help the property market, the Chinese government has signaled commercial banks to lower the mortgage interest rates. Okay, and on the other hand, the Fed's rate hikes have markedly driven up interest payment costs, coupled with the repricing of deposits after maturity. So fixed deposits after maturing, the interest rate tends to move up. So this also will exert downward pressure on the interest margin. Okay, the share price outperformed the market. You can see since January this year, keep rising to now is about 3. This is up to early May. We have not updated because we prepared this PowerPoint in early May. Now the share price has risen to close to $4, and now recent correction has brought the its share price to around $3.75. Currently, it's trading at around $3.75. Okay, now the P-book band, price to book value, is trading above fair value. Fair value is 0.407 times. Okay, now it's trading at around 0.41 times P-book, price to book. So we will recommend investor to wait for a lower entry price, which we will take the fair value, the 0.407 times P-book as a entry price. If its valuation corrects to 0.407, because its price to book is book value now. Its book value now is around 8 yuan, 8 yuan renminbi, 8 yuan. Which is close to 8.8 Hong Kong dollars. So if we take 0.407 this fair value as an entry price, it would be 360 Hong Kong dollars. If its share price drops to 360, we think it's a good entry level.